Warren Buffett's 7 investing rules that make an investor strong. Imagine an ordinary person investing money in the stock market for the first time. Red and green candles are moving on the mobile screen. Someone says this stock will take off tomorrow. Someone else says if you don't buy it now you'll miss the chance. That person gets trapped between fear and greed. On one side is the dream of getting rich quickly, on the other is the fear of losing their hard-earned money. And amidst this noise, an elderly investor in the world sits calmly, one who neither traded fast nor chased the market every day, yet became one of the most successful investors in the world. His name is Warren Buffett. The question is, when millions of people lose money in the market, how did Buffett build such massive wealth from those same markets? Did he have a secret formula, or just some simple rules that an ordinary investor can also understand? Warren Buffett is often called the king of value investing. In his life, he didn't just buy stocks, he understood businesses, made patience his weapon and turned market fear into opportunity for himself. In 2026, the leadership of Berkshire Hathaway has passed into the hands of Greg Abel, but Buffett's investing philosophy is still read and understood today, just as it was before. His greatest strength has been that he explained investing, not in complicated language but in simple common sense. His rules sound easy, but following them is not easy, because the real battle is more with your own emotions than with the market. Buffett's first rule is very direct. If you cannot think of holding a stock for 10 years, do not even buy it for 10 minutes. This sounds small, but it is the biggest line between investing and speculation. Many people do not look at the company when buying a stock, they only look at the price. They think that they will buy today, it will rise tomorrow, they'll book a profit and get out. But Buffett does not consider a stock a lottery ticket. For him, a stock is a small ownership stake in a business. When you buy a stock, you are actually becoming a partner in the future of that company. This is where an investor's thinking changes. If there is a company that you cannot hold for 10 years, it means that either you do not trust that business or you haven't understood it properly. Buffett likes businesses that can endure over time, whose products become a necessity in people's lives, and whose earning power does not depend on the daily mood of the market. This is why he looked at businesses like Coca-Cola, American Express, and Apple with a long-term perspective. For him, the question was not what the stock would do next week. The question was how strong the company would remain in the next 10 years. Buffett's second rule is, do not lose money. And the third rule, rather the second rule again, is never forget the first rule. This line might seem like a joke, but the entire discipline of investing is hidden within it. Buffett is not saying that you will never see a temporary loss in the market. What he means is, do not put money in a place where there can be a permanent loss of capital. A drop in a stock's price is one thing, but getting stuck in a bad business is another. Price can recover, but money put into the wrong business, wrong management, and wrong valuation often never comes back. An ordinary investor is often attracted by seeing the return, not the risk. They think the stock could double, but they don't think it could also become half. Buffett looks at the downside first. He asks, if things don't go in my favor, how safe is my money? This thinking is called a margin of safety. That is, buying any asset for significantly less than its actual value, so that the scope for error is reduced. This very rule saves the investor from haste, and explains that it is important to save money before making money in the market. The third big rule is, invest only in a business that you understand. Buffett calls this the circle of competence. Every human being's understanding has a limit. Someone understands banking, someone understands consumer products, someone understands technology, someone understands real estate. Wisdom is not about putting money into every industry. Wisdom is about recognizing your limits and searching for good opportunities within that boundary. Buffett often stayed away from businesses he did not fully understand, even if the world was chasing them. In today's times, this rule has become even more important. A new theme comes up every day on social media. Sometimes an AI stock, sometimes defense stocks, sometimes green energy, sometimes crypto, sometimes a small cap rally. People invest money just by seeing a trend without understanding the business. But Buffett's rule says that if you cannot understand how the company makes money, who its customers are, what its costs are, and what its strength is to fight competition, then it is better to stay away from that stock. Because if you don't understand something, you won't be able to hold on when panic strikes. Buffett's fourth rule is linked to emotions. He says, be greedy when the market is fearful and be cautious when the market is very greedy. This rule is easy to understand but very difficult to follow. When the market falls, news channels show fear, experts speak of recession, and investors do panic selling. At such times, even good businesses can be found cheap. but the fear is so great that people start selling instead of buying. Buffett remains calm at such times and looks for opportunities to buy good assets at a reasonable price. During the financial crisis of 2008, when the world's large financial institutions were under pressure, Berkshire Hathaway made a $5 billion investment in Goldman Sachs. Similarly, Berkshire's large investment in Bank of America happened in 2011 when the bank needed confidence. This point is very important because at many places it is cited as 2008, but the Bank of America deal was from 2011. Buffett did not panic in the crisis. He saw which institution was in a temporary problem and which business could survive in the long term. The fifth rule is to invest in a high-quality business. Buffett's partner, Charlie Munger, once said that it is better to buy a great business at a fair price than an average business at a cheap price. This very thing is clearly visible in Buffett's approach. Many investors get happy just by seeing a low price. They think a cheap stock means a good opportunity. But every cheap stock is not a bargain. Many times a stock is cheap because the business is weak, there is no growth, debt is high, management is not trustworthy, or the industry itself is in decline. A high-quality business is one whose earning power is strong, brand is strong, customers are loyal, management is honest, and the business model can endure for a long time. Berkshire started building a stake in Apple around 2016, and this investment became one of Berkshire's largest and most successful holdings. Buffett did not view Apple merely as a technology company, but understood it as a consumer brand. He saw that Apple's products had become part of people's habits, and its ecosystem power was very strong. The same thing is important for an ordinary investor as well. There are thousands of companies in the market, but not every company is worth investing in. An investor should see whether the company is making profits consistently or not, whether its debt is under control or not, whether its product or service is essential or not, and whether the management is honest with the shareholders or not. A strong business gives the investor protection as well as growth over time. If the price increases slightly in a weak business, confidence is not built. The sixth rule is, always buy at a price lower than the actual value. This is the soul of value investing. Buffett differentiates between market price and intrinsic value. The market price is what is visible on the screen today. Intrinsic value is what the business is actually worth, based on its future cash flows, earning power, assets, and growth potential. When the market makes a good business cheap due to fear or a temporary problem, that is when the opportunity arises for a value investor. One thing needs to be understood here. A cheap price and a low valuation are not always the same thing. A stock of 50 rupees can be expensive, and a stock of 5,000 rupees can be cheap if its earning power and future value are strong. Therefore, Buffett doesn't just look at the stock price, he looks at the quality of the business and future cash generation. He tries to understand how much cash the company can make in the coming years and how much value that cash will create for shareholders. For an ordinary investor, the simple meaning of this is, before buying a stock, don't just see whether the price has fallen or not. See what the value of the company is. Is the fall temporary or is the business in a permanent problem? Is the company making a profit? Does it have room for growth? Will the demand for its products remain? And most importantly, is the price you are paying fair according to the actual quality of the business? If the answer is not clear, then waiting is also a part of investing. The seventh rule is, if you get a big opportunity, don't play it small. Buffett says that many right opportunities do not come in life. When a truly fantastic opportunity is found, one should take action with confidence. This does not mean putting all your money into one stock without thinking. It means that once you have understood the business, the valuation is right, the risk is manageable, and the opportunity is rare, then do not limit yourself by making a very small investment. This rule demands courage. Many investors identify a good company but invest very little money. Then when the stock grows many times over, they regret why they didn't buy more. Buffett's thinking is different. He does not swing at every ball, but when he feels the pitch is perfect, he takes a big shot. This is why Berkshire's portfolio is not very scattered, but is based on selected high-conviction ideas. But misunderstanding this rule can be dangerous. A large investment is wise only when the research is strong, the risk is understood, and the investment is based on long-term logic. Putting big money based only on confidence or some tip is not investing, it's gambling. Buffett's big bet always comes after patience, analysis, and discipline. For him, an opportunity is not just a price fall, but a combination of good business, good management, and good valuation. Warren Buffett's investing journey also teaches us that being successful in the stock market is not the game of a sharp-brained mathematician. It is a game of temperament. You don't need to do something or other every day. Many times the best decision is to do nothing. There will always be noise in the market. Sometimes elections, sometimes war, sometimes recession fear, sometimes interest rates, sometimes inflation, sometimes a global crisis. But a good investor learns to differentiate between noise and signal. Buffett also made many mistakes in his career. He himself admitted several times that some investments were wrong. But his strength was that he learned from mistakes, he didn't cling to his ego, and he didn't leave his discipline. An ordinary investor should also understand this. In investing, it is not necessary to be perfect, but it is necessary not to be reckless. If you keep your mistakes small and let your right decisions run for a long time, compounding does its job. Compounding is the biggest secret of Buffett's entire story. Money doesn't just grow from returns, it grows with time. If you keep changing stocks repeatedly, compounding breaks. If you panic at every drop, compounding breaks. If you do quick profit booking and slow loss cutting, compounding weakens. But if you buy a good business at the right price and hold it for a long time, time starts working in your favor. This is the reason why Buffett's rules are useful not just for the American market, but also for Indian investors. Whether you look at large-cap stocks in India, mutual funds, index funds, or quality businesses, the principles remain the same. Understand the business, understand the risk, look at the valuation, think long-term, control your emotions, and be prepared when the opportunity comes. In the market, money is made by those who don't fight the market but maintain their discipline by understanding the market's mood. Today's investor has more information than before, but perhaps is also more confused than before. Previously, information was scarce, now information is overwhelming. There are charts in every phone, recommendations in every app, and experts on every platform. But Warren Buffett's philosophy shows a calm path through all this noise. It says that the real question in investing is not which is the next hot stock. The real question is which business you understand, at what price you are buying, and whether you have the patience to give it time. Therefore, if you want to become a formidable investor, these 7 rules of Buffett are not just for listening, but to bring into your behavior. Leave the 10-minute excitement and adopt 10-year thinking. Develop the habit of saving money before earning it. Buy only the business you understand. Do not let fear and greed dominate you. Instead of chasing a cheap stock, find a quality business. Understand the difference between price and value. And when a truly good opportunity comes in life, be ready to recognize and catch it. Because in the stock market, wealth is not built overnight. Wealth is built with the right thinking, the right patience, and by sustaining the right decisions for a long time. Warren Buffett's story tells us exactly this, that investing is not a fast race, it is a long journey. And in this journey, the one who moves ahead is the one who listens to the voice of their rules more than the voice of the crowd.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.